Any other? We have only one. We are ready to go for lunch. Okay.
Thank you, Violetta, for the question. I won't really name the names of the countries, but I think this tendency of politicians to push back and say, like, let's just raise the deposit insurance cover comes from a lack of understanding fundamentally of how deposit insurance works and how DI funds are constructed and all that. So certainly you would, the deposit insurer in this particular case was in quite a weak position. So I think they enlisted the help of the central bank and the supervisor to say that if this happens, if you raise the deposit insurance limit just like that, you're going to have a hole which will have to be plugged in the first instance, either by the central bank or by the Treasury. So it kind of comes full circle. And I think because the central bank is a little bit stronger in that network, that argument got through because the central bank doesn't want to be left with this hole where they have to then fund a sudden increase in the deposit insurance limit. But that is not an ideal situation, of course. You are kind of like, picking players to play off against one another. So I guess continual engagement of the Treasury from the start of resolution options, what it means for the Treasury before you hit that point where let's just take a quick decision to raise the deposit insurance limit. That, I think, would be a more ideal situation. Thank you.
So have one.
Thank you, Chuin, for that presentation, and thank you for making it all the way from the Toronto Centre to be with us. You mentioned the need for a handbook for crisis management, and I wanted to know how long, in your experience, does it take to come up with such a book? Thank you.
Thank you, Julia. I think it's quite a hard question to answer because it depends on the level of cooperation there is existing among the safety net participants. So in the example where I was mentioning, where the heads of the central bank and the supervisory agency didn't get along, it basically stalled for years until the two guys came that could get along with each other, and then it accelerated. Luckily, they did not have a crisis in that time. But if there is enough, now I think it would be difficult to put a kind of calendar time frame on it. But I think if there's coordination among the safety net participants, it can be done, let's say, within a year. I mean, don't quote me on that. It really depends. Because in that, you want a lot of templates, right? You want a lot of legal powers. So if in coming up with the crisis binder, it's not a one-off exercise. It's iterative between the crisis binder and then you test. And then when you test it in a crisis contingency, you find that actually, we don't quite have the flexibility. The crisis simulation throws up a need for a larger line from the central bank as a backstop to the DI fund, or there's need to involve the Ministry of the Treasury. Then you go back again to the drawing board to request for more legal powers. So the iterative process actually can take really long, apart from just interagency coordination. So it's hard to put a date on these things.
Now, most of this crisis handbook you have talked about is normally made during peacetime.
Oh, sorry, where's
But
the
the application normally,
yes,
the crisis handbook
yes,
is
yes,
normally made during peacetime.
Yes, sir.
Even the practice you're talking about is made during peacetime. And normally people doing it, they know they are doing a drill, which is sometimes, unless you make it to look real, they know this is a drill. But when actual crisis comes, people tend to panic It's not that because they don't know, but
Absolutely.
what do you advise? How do you train people to overcome panic during peacetime so that when the crisis happens, they are able to control, they are able to have self-control?
Yeah.
Let me just add to that question, then you answer together. During simulation, the simulation may be done during a time of training. For example, the instance you have given us, where Toronto Center was carried out the simulation and guidance. Now, in practice, decision makers may not necessarily be in those simulations. How can the gap be narrowed between participants who are taking different roles in the simulation and the decision makers?
Thank you. Thank you. I think those are very, very pertinent and relevant questions. It is, panic is part of human nature, right? And it's never ever possible to recreate that kind of war scenario or panic scenario if everybody kind of knows it's a simulation. But I think the purpose of the crisis binder is to remove, in a sense, remove the human element out of it as much as possible through protocols, through forms. So like the case I was saying, I mean, information sharing should not be based on friendship. Like you are friends. I'm a deposit insurer. My friend is in the supervisory authority. We are friends, therefore we share information. That's a human element that we're trying to remove through this process of having formalized protocols. And similarly, panic is probably a result of not knowing what the protocols are, not very sure whether you're being empowered with certain decisions. It suddenly popped into my mind, I'm not sure whether you have seen the movie Apollo 13. Yeah? This was when there was a space shuttle out there, and it ran into serious problems out there. What struck me from that movie was they had a handbook for every single scenario. Every single scenario. So when time was running out, it was not like, okay, what do we do now? Let's think about it. No, it was like, there was a handbook in that space shuttlecraft that says that you turn on this dial, you turn off that valve. And that's what we're trying to recreate. I mean, the panic will never be as real. The best way to learn to prepare for crisis is to experience a crisis. But short of that, I think the crisis binder is probably the second best way to go. And to Charles' question, decision makers. Actually, in some of our simulations, we do have the decision makers involved. The deputy governors, the governors, heads of agencies, and sometimes they have the technical staff involved. So in the Nordic-Baltic simulation, we did have very senior people involved. And I think it's very, very useful for the decision makers to be involved and to see for themselves what this means. Because the simulation is not run for its own sake. It's run to identify gaps in your protocols and who has the decision to close those gaps, who has the power to close those gaps. It would be those decision makers. So I would highly recommend that decision makers be involved in these simulations.
Thank you, Chief, for your excellent presentation. Mine will be more of comments just to reinforce your points.
Yeah.
And maybe for Uganda, we in Kenya have already developed a resolution handbook with the assistance of the World Bank, so maybe we'll even share with them once it goes through the whole motion. It's a very good book, and we realize actually it's one of the instruments that we need, is one of the kits we need in our toolkit, as you talk about the binder. And then number two, on the issue of fear. Of course, naturally the fear will be there, but once we do simulation maybe as frequent as possible, maybe possibly every 2 years, we can come to appreciate what problem banking is. We can even see where our gaps are. Then we can indeed prepare. But one thing I want to underscore is the interagency relationship. I think that one is key for the success of any resolution. That is the central bank and even the members, the banking industry. I think the banking industry should not sit there thinking that that's only the work of the central bank and the deposit insurance. They should also play a role to see how we can resolve some of this problem banking. And I think we should be engaging more. Beside even some of those frameworks that we have, we should indeed have a kind of a borderless relationship where information flow can be as efficient and as effective as possible, because information is power. So that once a bank starts now showing just some distant signs of distress, these agencies can now meet and start even now simulating. That's why we can even apply even the simulation. If this bank goes south, how do we bring it back to north? Even if it's not going south, but we have also to start now thinking about that. So I think what I will underscore is the interagency relationship for the success of an effective resolution. Thank you. Mine was a comment, actually.
Thank you so much.
Thank you very much. We have come to the end of our discussion for this session. I would like to thank our speakers so much for enlightening us, especially on the issue of preparing to the crisis handbook and starting some kind of simulation and enabling to grow and become a tool which can help us during crisis. Madam Chui, I want to thank you so much. Help me to thank our speaker.
Thank you.
Thank you very much.
Thank you.
But right now we have a session on bank resolution and financial sector stability. It's a Bank of Uganda case study. I'm going to invite the session moderator, and he will introduce to you our speaker this afternoon. Mr. Vusi Vuma from Zimbabwe. We met him yesterday. A round of applause as he comes to the platform. And he will take us through what next.
Thank you, Madam. Good afternoon, everyone. I also take this opportunity to welcome the Chairperson of the ARC, Mr. Umaru Ibrahim. I think he has arrived, maybe he's still outside. Welcome to the last session of this conference, which is focusing on bank resolution and financial sector stability. It is imperative to note that notwithstanding the best supervision practices, banks can still fail. You can hire even the special forces from the states, but they will not stop bank failures. Achieving financial stability requires a well-coordinated safety net framework where the deposit insurance complements the bank supervision framework and the failure resolution framework without necessarily focusing on protecting depositors. Regulatory intervention through directives, guidance, and moral persuasion foster financial stability and at the same time induce greater efficiency of financial markets. We have other jurisdictions that emphasize in their public policy objectives the mandate of fostering financial stability and also enhancing public confidence, as well as performing bank resolution functions. So it depends on the architecture or design of each public insurer, whether the resolution function relies within it or is within the central bank or some other supervisory authority. It is at this juncture, ladies and gentlemen, that we have an eminent person. I think I'll put a disclaimer. If I get this wrong, Doc, don't sue me. But I'm told that your name means that you are a hero. And I'm assuming that you are a hero of bank supervision. Ladies and gentlemen, to help us unpack this particular topic, we have Dr. Tumwebweni Tunemanzi. In short, I'll call him Twine. Twine. My apologies. Dr. Twine is a PhD in economics, a master's in economics, an MS in management and administrative sciences, all these acquired from the University of Texas in Dallas, USA. He has received training in quantitative competition analysis at the Barcelona Graduate School of Economics, in utility regulation and strategy at the University of Florida. He's also a founding member of the Academy of Regulatory Professions at the Public Utility Research Center of the University of Florida, which is a forum for the exchange of best practice ideas among utility regulators from around the world. He was a lecturer at the University of Texas, Dallas, where he taught mathematics for economists, asset pricing theory, and advanced macroeconomics. He has over 15 years of combined experience in the retail banking, telecommunications regulation, and in structured finance for greenfield infrastructure projects in Uganda. He is currently the Executive Director of Supervision at the Bank of Uganda, a position that he has held since March 2018. Prior to this, Dr. Twine was the Director, Industry Affairs and Content Development at the Uganda Communications Commission, the regulator for the telecommunications, broadcasting, and postal subsectors in Uganda. While at UCC, he was pivotal in the establishment of an interagency collaboration framework between the Central Bank of Uganda and the UCC for the co-regulation of the mobile money ecosystem in Uganda. He also represented UCC on the committee that developed the financial inclusion strategy for Uganda between 2017 and 2022. It should be noted that collaborative initiatives, including furthering the adoption of open APIs for financial services development, are integral to his brief as the Executive Director of Supervision at the Bank of Uganda. In his current role at the Bank of Uganda, Dr. Twine is tasked with providing oversight over the prudential operation of both commercial banks and non-bank financial institutions, in addition to keeping an eagle eye on the state and degree of stability of the financial sector. In addition, he has been a facilitator at a training workshop for mobile money and agency banking organized by IMF and Bank of Uganda in Uganda, presented at the Mobile Money and Digital Payments Africa 2015 conference in South Africa. He was an invited panelist at the Responsible Finance Forum held in Turkey in 2015, and more recently was an invited panelist representing Bank of Uganda at the very first blockchain technology conference in Uganda. He is an active contributor to the focus group at the ITU on digital financial services and in the development of the terms of reference for his successor focus group that is evaluating the potential of digitally issued fiat currency. Ladies and gentlemen, you can see from this brief resume that we are honored indeed to have Dr. Twine here. As I called him the hero of banking supervision. Please help me welcome Dr. Twine to the podium. Thank you. Before I allow him to start his presentation, I noticed that our chairman has arrived. Warm welcome, Mr. Chairman. Thank you very much. I take note that Dr. Twine is a former lecturer, so I think I'll need to be very strict with him. You know, lecturers, once they start talking, they don't stop. I'll give him 30 minutes so that we have a sufficient question and answer session. So, Doc, you have 30 minutes or less than 30 minutes. The floor is yours.
Thank you, Vusi. Good afternoon, ladies and gentlemen. I thought you'd have a bit more energy, considering that you've just stuffed yourselves with enough carbohydrates. First and foremost, I am privileged to be able to make a presentation to this honored gathering here, except that the first time when I was first approached about the particular topic, I thought it was an attempt to disguise, an attempt at taking me through the parliamentary probe again. So I was just talking about bank resolutions and financial stability, the Ugandan experience. There's something Vusi mentioned, as we began this afternoon session and said, we can't prevent bank failures, and that is entirely true. Regulators, resolution authorities are not there to prevent bank failures. The main responsibilities, I believe, are two. One, reduce the likelihood or the probability of the occurrence of a failure. Now we're moving to statistics. Reduce the probability of occurrence. Then two is to minimize the impact of a financial institution failure when it occurs. So it's not an issue of if it will occur, the question is only when. The Ugandan experience, and largely this is the structure of my presentation today, we talk about the standard resolution cycle. I'll touch a bit about the Financial Stability Board, key attributes of an effective resolution regime. I'll talk about the bank resolution framework as it exists today in Uganda. Then we'll go to the most interesting part of today's presentation, which is the experience. And then look at if there's been any impact on financial stability. And then we'll sit down and have a discussion, brief, I know I've been given 30 minutes, on the enablers. In other words, you might have the key attributes in place. You have the laws. The bigger issue is what else, what are the other soft things or the non-legal, non-regulatory things that you need to have in place that will enable you be able to conduct resolutions as and when they are required. And then, of course, most importantly for Uganda, what have been our lessons from this journey? Before I begin, first, I wanted to clarify something. I know there was a bit of a debate, I think yesterday or the day before, where we were not very sure about how many financial institutions have been resolved in Uganda since 1986. The number is 7. 1 in 93, 2 in 98, 1 in 99, 2012, 2014, and 2016. That makes exactly 7. So I just thought I would clear the air on that particular item. So the Financial Stability Board put together key attributes of a resolution regime. And I'm not going to read all of them, but largely it must be very clear who is the authority responsible for resolution of institutions in the country. Just to note that these key attributes with some adjustment are also applicable to the insurance subsector or the pension subsector. So with adjustment. If you have a clearly identified resolution authority, what are the resolution powers? In the resolution process, how do you deal with collateralization? How do you segregate client assets? I know in Uganda's case, there is the issue of escrow accounts for mobile money. Should those assets be available in the resolution process or not? Those are issues that need to be discussed. What safeguards do you have in place? How do you fund the resolution? Then more importantly, what's the legal framework in place that enables cross-border resolution? Because increasingly, institutions are not restricted in terms of the operations or their impact to one geographical area. In other words, we're getting to a place where financial institutions or other similar institutions have an impact or effect or even to conduct their business across borders. Then crisis management groups. To what extent are the various regulators within the financial sector or other sectors working together in identifying, managing both pre- and ex ante and ex post of crises? How do you determine whether an institution is a candidate for resolution or not? Then recovery and resolution planning, and more importantly, matters is number 12, the access to information and how you share information. So the resolution cycle. The first question normally is the bank viable? Viable along very many parameters. Is it capitalization? Is it the extent of the loss-making loss-making characteristic of the bank or the institution? Does it lack liquidity? Are there shareholder issues or is the shareholder distressed? Corporate governance, which tends to be the source of the majority of the issues. Are there weaknesses? And then at that point in the decision process, a decision has to be made whether a takeover should be done or not. And if the decision to take over has been made, the next question, and that's why I put those two boxes in red, is a decision has been made, this is for banks, whether it's systemically significant to the extent, the degree of its interconnectedness across the economy or within the financial system. Then a decision is made whether you have an orderly wind down, in which case the deposit protection schemes and deposit insurance schemes come into place, or you make a decision on what kind of resolution regime. Is the focus on continuity? Is there an option for continuity? Bail-in, transfer of assets and liabilities? Is it better to arrange temporary public ownership where you rearrange management and perhaps recapitalize it and bring it back to market, similar to what was done for institutions like Royal Bank of Scotland or AIG in the US? And then in the event that you have agreed on a resolution regime, if there is any residual assets or residual institution, how is it dealt with? Its assets and its other resources. So for Uganda, I tried to summarize largely how the decision is made. So the first objective is we want to ensure that there's continuity in critical functions. The next is contagion. How do we avoid it? Not just minimize it, but completely avoid it if it's possible. The third consideration, and in no particular order, but the third consideration is financial stability. To what extent is this resolution decision going to have an impact on the stability in the financial sector? The next one, what's the impact of a resolution decision on market discipline? Does it increase existing moral hazard considerations? Does it remove them? Does it encourage or foster the right kind of behavior we are looking for? Then there's the issue of use of public funds in the resolution. And then safeguarding depositors and covered investors. Those are the objectives of any resolution decision. At least for Uganda's case, looking at the history, those have been the kind of objectives that have guided us. Of course, these are more or less primary. There are probably other secondary ones, but I chose to focus on the primary objectives. Then what are the triggers? What's the likelihood of the failure of this institution? Is there no alternative private solution to avoid a failure? And is its resolution in public interest? For those who are lawyers, public interest, even defining it remains very vague. But those are things that the triggers that make you decide. And exactly, that's one of the things. Yes. And lastly, when you look at the principles of any of the resolution decision, are the covered depositors protected? The priority is always the first ones. And we'll get to the Ugandan experience. And because in Uganda's case, on principle number one, we, in 1998, in the resolution of Greenland Bank, which is currently Greenland Bank in liquidation, the government made a decision to cover all depositors in full. Okay? The condition of equal treatment of creditors, I believe that's the Latin translation. I will not attempt to pronounce it. But the whole idea is that creditors of the institution that's being resolved are all treated equally, or at least according to the pecking order of finance. There are issues there, whether the replacement of management and directors, how it's going to be done. And the other one is that the resolution burden should be shared with the shareholders. So the framework in Uganda, the laws, the guidelines, the regulations that we currently use, one is the Financial Institutions Act, specifically I think from section 85 down to about 96. Those provide for the powers of the central bank as the supervisory authority, which has also been taking on the resolution authority role, and gives the powers in regards to how institutions are resolved. With regards to risk and problem identification, we have a risk-based supervision manual, and we have in place a regular supervisory cycle and supervisory reviews. The next is we have a series of memorandums of understanding with peer regulators across the region, especially with the EAC, and through supervisory colleges with the home regulators of the multinational entities or financial institutions operating in Uganda. On the fifth one, sound and comprehensive framework for bank resolution, we are in a development stage for a problem supervised financial institution resolution guideline, which is currently under development, but it basically is building upon our experience as Bank of Uganda since our establishment in 1966 to date. And then most importantly, we have the sufficient human and financial resources in terms of the training, in terms of the experience they have gotten with having secondments to regulators that have got experience dealing with resolutions. So, the resolution experience. Like I said earlier on, we've resolved 7 banks since 1986. In actual fact, since the establishment of Bank of Uganda in 1966, all the banks that have been taken over and or resolved have all occurred in the space since 1986. So for the first 20 years of Bank of Uganda's existence, it was smooth sailing, so to speak. I'll start with the last one, Crane Bank, which has been the most problematic. Resolution date was October 20th, 2016. The triggers were undercapitalization, insolvency, and the failure to recapitalize within a specified period. But also, more importantly, there were governance issues for this institution. The resolution type and process, first, it was a takeover of management and of the board, which according to our act is termed as statutory management. And in that period of October 2016 to January 2017, Bank of Uganda, as the resolution authority, did inject liquidity support. Now, the decision to take this approach for Crane Bank was, it was a systemically important bank by our own definitions as Bank of Uganda. During that period, there was the conduct of a forensic audit. The bank was moved into receivership in January, and the sale of the bank within the provisions of the FIA was through a method which we have since preferred since about 2010 of the purchase of assets and assumption of liabilities. There was an attempt to work out a confidential settlement and release agreement with the key shareholders. and then the residual assets and liabilities have been retained by Bank of Uganda as the receiver. Subsequently to failure of the confidential settlement and release agreement, Bank of Uganda then filed a case against the shareholders, and the receivership process is ongoing. Just to give you an update, our initial filing of the case has since been set aside by court, a process which we are appealing. So in other words, that our resolution process, we also subject to the normal court process. The challenges, and this is where once you have all the necessary regulations, laws in place, a lot of care must be taken. From the Ugandan experience, the procedural mistakes, both during statutory management and during the receivership process, some of which we have paid dearly for in terms of the erosion of the central bank's reputation. We've taken quite a bit of a drumming through the press and through the various parliamentary committees we have had to interact with and provide accountability to. There was the failure of the attempts to resolve out of court the confidential settlement and release agreement, and then the court processes. Remember, the case was filed in June or July of 2017, and the ruling was only made in August of 2019. Then, of course, the parliamentary probe, which, much as the parliament does have oversight, the issue was that to what extent are they diverting the resources of the resolution authority from the resolution process to focusing on answering questions. Perhaps it would have possibly been better if the questions were to be asked after the process has been completed. And of course, there was also the issue of incomplete records and documentation for the liquidity support. Global Trust Bank, the resolution date was July 2014. The triggers, the major trigger really was shareholder fatigue. It had gotten to a point, this was an institution that from its inception, about 4 years before, had never turned a profit. So it had not demonstrated the ability to be able to grow its own capital base organically. So it got to a point where literally every year, there was always a capital call. So it gets to a point where you ask, at what point, how sustainable is this? So when the shareholders demonstrated a bit of what I choose to call shareholder fatigue, then it became apparent to the central bank that something drastic needed to be done. Now, the resolution type for this one, considering that it was a bit of a smaller bank, was we had a statutory takeover and closure by the Bank of Uganda, the purchase of assets and assumption of liabilities agreement, and then immediate transformation into liquidation. So statutory takeover was on a Friday. The purchase of assets was done over the weekend, and on Monday, the institution, with the assets and liabilities transferred, was then moved into liquidation for within the residual assets. This one has been a problematic one because there have been numerous legal suits against Global Trust Bank in liquidation. So it's one of the reasons why it still remains incomplete. However, we've since made some significant progress, and we have had discussions with the shareholders, and it's our plan and intention to have this particular bank whose resolution concluded by December this year. National Bank of Commerce. National Bank of Commerce, there were shareholder disputes. At the time we stepped in, there were majority shareholders and minority shareholders, and there was a legal action by minority shareholders against the majority shareholders. So, and at that time we had put in a capital call, so then the issue became how would they contribute the extra capital if they could not agree on who owns what. So similarly, initially we started with an interim management oversight, and then that was progressed to a statutory takeover and closure by the Bank of Uganda. There was a P&A agreement, and then liquidation, similar to Global Trust. The challenges. when you look at the existing law that I mentioned, the Financial Institutions Act, it actually prevents the entertainment of any proceedings against the liquidation or bank resolution process against Bank of Uganda. But somehow an injunction was issued and that stopped the sale, the process of liquidation. So while the P&A went ahead and the obligations under the purchase of assets and assumption of liabilities was taken over, the process of liquidation could not continue because there was an existing injunction, which, as an update, was only set aside in June this year. So from 2012 to 2019, that injunction has stayed any action or possibility of actions towards the liquidation of this bank by Bank of Uganda. The other challenge with the National Bank of Commerce is that National Bank of Commerce was bought by Crane Bank in 2012. And then Crane Bank itself was in turn sold off in 2016. So you can imagine some of the assets acquired in 2012, having a traceability process for them after 2016 when the acquirer in 2012 was taken over by someone else. And again, most importantly, if you look at the last challenge, there's been a lot of asset wasting. The injunction has stopped any action in liquidation. It meant that whatever assets, fixed or otherwise, that were not taken over and under the purchase of assets and assumption of liability, we had to put in storage. So imagine furniture or old ATM machines that have been in storage for 7+ years. Now that we have the injunction set aside, it is even questionable what kind of value we can be able to realize out of these assets to be able to pay off any outstanding creditors. So in a nutshell, that's really basically has been Uganda's experience. Now, what has been the impact on financial stability? Because remember we said one of the critical success factors is containing or managing contagion or avoiding contagion. Our preferred method for the resolution of banks has always been, since 2010, has been the purchase of assets and assumption of liabilities. The matching, and where there's a netting off, we either pay or they pay, the acquiring entity pays for the difference. Here are some interesting facts. Between June 2012, remember the first bank was closed in September 2012. Between June 2012 and June 2019, which covers the 3 banks I have mentioned, total assets in the sector actually grew by 110% to about 30.3 trillion. That's in nominal terms. Gross loans and advances, 89%. Customer deposits, 115%. So you might say, but perhaps those are just in nominal terms. If one controls for inflation and real exchange rates, perhaps it would be less. So we say look at ratios. For the same period again, under capital adequacy, looking at the ratio for core capital to risk-weighted assets, one would say there's been a slight improvement. So we moved from 18.3% in June 2012. You had an uptick after the takeover of the first bank to 21.3, and then a slow downward. It came down slightly to 20.3, and then since then has been oscillating between 18.8 or 19 and 20. Asset quality, another measure of impact or stability, the extent of stability within the sector. The non-performing loans to total gross loans as a percentage. The only time we see a significant uptick in or impact within on the financial stability point of view or perspective is in June 2016 when the non-performing loans to gross loans, the percentage went up to 8.3%. Okay? But remember that is June 2016, prior to the resolution of October 2016. And the reason why you have this uptick in June as opposed to October was that the on-site examinations and the off-site examinations, which forced the reclassification of existing assets for Crane Bank at the time, is what bumped up the total asset non-performing loans in the sector, and was the basis for the capital calls which were not complied with, and therefore the takeover by the central bank. Looking at earnings, return on assets. Return on assets dipped from 2012, has dipped slightly, but has remained constant more or less, with not big variations ranging between 2% to 2.9%. So it has fluctuated in a range of about 100 basis points over a 6-year period. Liquidity. The percentage of the ratio of liquid assets to total deposits has remained significantly comfortable, because remember our prudential requirement is 20%. So even despite the fact that we've had all these resolution of institutions, look at 2012, look at the figure for 2014, look at the figure for 2016, we have remained so consistently above that threshold that would have caused us significant worry within the sector. So, in conclusion, I would say comfortably that the recent bank resolutions have not raised significant financial stability concerns, as credit quality has remained satisfactory and banks in Uganda continue to hold adequate capital and liquidity buffers. Now, earlier on, we talked about enablers. So we've had the resolutions, we've seen the experience, we've noted that there has been a muted impact on financial stability. What are those things that we also have had in place or we need to put in place that have helped us have this kind of experience, in our opinion, in our own assessment? Those who conduct an independent assessment might choose to disagree. One, I believe that one of the enablers for the experience we've had has been our focus on having the resolution of financial institutions guided by the principle of least disruption to the wider financial sector. Two, the fact that our licensing regime in Uganda is where we ring-fence subsidiary operations from the parent. So an entity registered in Uganda is registered as a subsidiary and is a standalone, as opposed to the branch licensing model. Three, we believe the information sharing channels and the common supervision protocols between the peer regulators, especially within the East African region, have been very helpful. Four, that there's been extensive multi-stakeholder involvement of the central bank, the deposit insurer, and the Minister of Finance or the Treasury. The other set of enablers, that we've had regular legislative reform and review of the regulatory and supervisory practices needed to strengthen the bank resolution frameworks, even though that review process has not yet been complete. So it's an ongoing process. We've also had, we try to maintain regular institutional profiles and access to data for timely decision making. Then there's the process confidentiality. The confidentiality around the processes or in the conduct of these resolutions is equally as important as the method or the approach one uses or the resolution regime one applies to an institution. And so far, largely, we've been rather successful on that. Except that now, in the last 2 years, I would say that with the coming to age of social media and information anywhere, anytime perception, this is going to become increasingly difficult. But nevertheless, it's something that has helped us and been in our good stead to date. And then, of course, there's been the effective management of expectations and trying to minimize uncertainty. If over the period where we've resolved 7 co-institutions over I would say almost a 20-plus period, the fact that we have less than 20 suits by employees against the closed banks means that to a large extent, because these institutions combined probably employed closer to 3,000 people, means that to a large extent we have managed the employee expectations or uncertainty employees have whenever bank resolutions that have occurred in Uganda. So now we turn to the lessons learned. Someone once said that prevention is better than cure. I agree. Risk identification. The development and the monitoring of early warning indicators. Strengthening the off-site and the on-site surveillance. And something that is becoming increasingly important in the day and age where banking is increasingly becoming synonymous with technology is having real-time data and real-time data analytics. 2, early intervention. So the idea of regulatory forbearance, as much as possible, should be removed. Corrective actions and follow-up. To what extent is it, how effective is your regime for corrective actions and the follow-up? Do you monitor, do you manage the conduct of these institutions and management behavior? Because remember, the institutions are entities that we have persons. It's the people within the institutions that matter. So perhaps we should begin, what we are looking at is beginning to consider and borrow from lessons in behavioral economics and behavioral science, that depending on how one sets up the incentive structure, one can influence and get the kind of behavior they want or they need. The behavior of the people within these institutions determines the conduct of these institutions, and if it's structured right, you then have, you basically minimize the possibility of them failing or failing in a significant way. The other one that we are also looking at, the lesson learned, is rules versus discretion. Rules-based regulatory supervisory regime versus principles-based or maybe perhaps activity-based. When you have rules as the basis for your supervision and regulatory regime, there is not too much built-in flexibility. In a situation where the financial sector is constantly evolving, while rules are helpful, there should be some inbuilt flexibility, which means some extent of discretion or perhaps principle-based regulation. And then the other one, very important for us, has been crisis management. I would like to report that in Uganda's case, we've actually created the Financial Sector Regulators Committee, which includes the Deposit Protection Fund. And what we're trying to do is come up with a multi-sectoral or cross-sector crisis management plan. That's both ex ante and ex post. That in the event one institution in one subsector of the financial system is having a problem, what should the other regulators in the other systems do or prepare themselves for? And then looking at that, we're going through a review of an existing regulatory framework, but this time not having backward looking, because there's a tendency to go through what I call the horse stable syndrome, building a very good lock for the stable long after the horse has bolted. Perhaps, and this is where our learning lessons are, is that we should begin building a better stable so that the probability of a horse escaping is minimized. So that's the future-proofing of our regulatory framework. And like I said, the Financial Sector Regulator Corporation. So, ladies and gentlemen, that, in a nutshell, has been Uganda's experience, the impact on our financial stability, and more importantly, the lessons that we have learned and that we intend to apply. Before, if I may, if there are any questions, what we currently are trying to figure out in Uganda is a fundamental question which in some jurisdictions has been answered very clearly, but here still remains something of that depends the guidance of the Minister of Finance and other stakeholders. The question was, Bank of Uganda as a supervisory authority, should it also be the resolution authority? In other words, is the resolution regime where you have a resolution authority separate and distinct from the supervision authority the best, or is it something that we should consider? That, to me, right now, is the fundamental question we are trying to figure out. Ladies and gentlemen, thank you very much.
Thank you very much, Doc, for largely being materially compliant. I think you have exhausted all your 30 minutes. Ladies and gentlemen, can we have another round of applause for the Doc? I now open the floor for any questions or contributions. What's this? Mahmoud here. I think we'll take 3 questions at a time.
Yes, I think I'm getting your name right, Dr. Twine.
Yes, sir.
Or Twine.
Twine.
Twine. Okay, Dr. Twine, thank you so much for that detailed and elaborate presentation. And it's good you also cleared the air about how many institutions were closed, because I think it was, and I think the governor too said it is 7. So I think you are the custodian of that information. Thank you so much. Thank you so much for that. Mine that is a question and a comment. Maybe I'll start with the question. When you talked about global trust, you say that you closed it on a Friday, and by Monday you had sold, you had transferred or sold the assets. Is it that you worked throughout the 2 days to sell the asset, or was there a prior engagement in that? Because I think that will be too magical that within 2 days you sell the assets of a bank. That is 1. 2, you ask a very pertinent question to all of us, your last question. I think the best practice is the resolution authority should be outside the central bank, because central bank is the licensor, the regulator, the supervisor, and it can also not be the resolution authority. So the best practice is the resolution authority should be outside the central bank, and preferably should be sitting with the deposit insurance. Thank you.
Anyone with another question? At the back there.
I'm Damien Katota Amale, to Finance Bank. Director, I wonder whether there were any governance issues identified in the resolution of those institutions you have mentioned, because normally governance is a very big factor when it comes to the management of banks. Were there any problems as far as governance was concerned? Thank you.
Thank you so much for the presentation. But for me, one area that is probably not well covered is the area of lesson learned. People who are involved in the management of those banks. I've not seen in any area of your presentation where those people actually brought the book. Because in taking lessons, you must also show examples. So the law should be so comprehensive enough to bring people to book so that it can prevent such occurrence in future.
Thank you. Let me just give Rosen.
Dr. Twine, it's a pleasure to have you here. My question is related to financing these resolutions. I'd like to hear from you more about how these resolutions were financed, who bore the losses, and do you draw some lessons on that front?
Thank you for the questions. Doc, you have the floor.
Okay. Let me start with the last one. The financing of these resolutions. For in the structure for Global Trust and National Bank of Commerce, NBC, there was no net effect on the, significant effect on the Bank of Uganda's balance sheet. Because in the purchase of assets and assumption of liabilities, what happens is that all the liabilities, especially the depositors, are taken on by the acquirer, and in turn they are given the equivalent in assets to match the liabilities they are assuming. In actual fact, for the case of Global Trust, it was found that the assets that were being given to the acquiring bank were slightly less than the liabilities the bank was being asked to assume, in which case the resolution authority, which was Bank of Uganda, paid the acquiring bank and some money, okay? So for those, and that's the beauty of purchase of assets and assumption of liabilities, the impact, first of all, on the deposit insurance scheme, the impact even on the resolution agency is minimal, okay? Crane Bank, slightly different. Crane Bank, one of the fundamental issues, and which kind of answers the question someone asked earlier on about governance, where while all these three banks had governance issues, the governance issues in Crane Bank were significantly larger. That's one. Two, it was a systemically important bank in terms of its reach, balance sheet size. So there were not too many entities that had the ability to swallow it, so to speak. So there was there was selective assumption of selective liabilities for which matching assets were provided. The excess assets, which were considered of diminished quality, were then retained by the receiver. But for Crane Bank, because we also took the bank through a 4-month period of statutory management, Bank of Uganda then grew its balance sheet to be able to extend liquidity support. So that impact, however, we've had to report on our balance sheet and has created a significant dent on the central bank's capital base. So while you might say, but wait a minute, so in the lessons learned, how come you have not mentioned the funding of these institutions? I think I did. If you look at early intervention under risk management, risk mitigation, one of the things under risk mitigation, if I was to blow it up, is that a priori, either with agreement that the central bank with the Minister of Finance or the Treasury should agree, have permission or authorization to grow the balance sheet to be able to fund certain bank resolutions in the event that's necessary. Of course, it then is also conditioned on what the gentleman from the Deposit Insurance Scheme from Kenya said, the CEO, was if the resolution agency is different from the central bank, then that agreement with the Treasury should be with whoever is doing the resolution. That in advance, maybe and perhaps once a year it's reviewed, the Treasury allows the resolution authority to either grow its balance sheet or have access to certain funds to be able to conduct any resolution in the event it happens. That way, when you are moving into a resolution, you don't have to go back and start, because in a resolution, the more people that know about it, the less likely it's supposed to succeed. Which then takes me to the question of how do you take over on a Friday and have a new owner on a Monday? Once the decision to take over is made, and perhaps if you'll allow me to go back earlier on, once the decision to take over is made, and you've determined perhaps that the bank is not, whether it's significant or not, at that point, there will be a team that then decides, asks quietly which institutions might be interested. And this normally happens 3, 4, 5, 6 months before. They sign those that might be potentially interested are approached. They sign non-disclosure agreements, and then because at that point the problem institution is probably under close or daily monitoring, the supervision authority then makes available data, performance data, financials of the institution under question or under consideration available to those who are interested in perhaps acquiring it. So then, and that's for Global Trust and also for NBC, the discussions happened over a 3 to 6 month period prior to the actual takeover date. So by the time there's a takeover, there has been a discussion behind the scenes for about 3 to 6 months, which is why I said one of the enablers is the degree and the extent of confidentiality surrounding this process. Now, to minimize the impact is that and that's it's also an approach taken by a number of resolution authorities, is that you walk in on perhaps just before a weekend or a public holiday with the entity that you have agreed to take over. Of course, in the purchase of assumption of purchase of assets and assumption of liabilities agreement, you build in certain safeguards, maybe perhaps that the acquirer has up to 60 days to verify and confirm that which they are taking over and have the ability to return or not return. So that is how it is possible to take over a bank on a Friday and have a new owner running it on a Monday. There was a question on governance. I think I mentioned it, but governance indeed has been the common thread throughout. It's been the common thread throughout all these resolutions, which basically means it's the people problem. Because if the people and if the people are the problem, then the question becomes, how do you get them to do the right thing? There could be a threat of jail. We could go the approach of maybe arranging for corporal punishment for non-compliant managers, but that doesn't get you the action that you want. Like I said, we are beginning to borrow a bit from behavioral science and behavioral economics, that people respond to incentives. Structure the incentives right, and you'll get people to do that which you desire. So on the question of saying that, in lessons learned, how come there was nothing specific about people? It's under behavioral change. It comes under risk management, but also more importantly under the early warning indicators. Borrowing again from behavioral science, we look at what makes people make the decisions they do. Why do people make the decisions they do in the way that they do? Sometimes there have been various books and literature on this matter, why otherwise intelligent people make seemingly irrational decisions. Is the presumption that everyone makes rational decisions? Does a rational mind exist? These are fundamental questions that remain unanswered in economics, and that's why economics now borrows from psychology. But we've since realized that if the incentive structure for good behavior, both incentive in terms of with consequences and rewards for good conduct or good behavior, if that is done right, the people question gets solved. And that's why we have if you look under early intervention, financial institution conduct and management behavior change. So that's where the people issue is addressed. And lastly, I will agree with the CEO for the deposit insurance scheme in Kenya, that worldwide I agree there is a trend of, yes, separating the resolution role from the supervisory role, and increasingly the resolution role is being assigned to the deposit insurance scheme. But in Uganda, the fundamental question is we have to ask, does the deposit insurance scheme have the capacity today to take it on? Should it be a transition to assign the role, have the existing person playing the role, slowly over time building the capacity within the institution? Unfortunately, that is something that requires us going to Parliament, getting the consent of the Treasury, going to the Parliament and amending a whole new law. What's the process for the law? In the interim, what do you do? So while I agree with what the worldwide trend has been, that deposit insurance schemes are increasingly becoming responsible for the resolution of institutions, of failed institutions or problem institutions. On a case-by-case basis, one has to determine, look at the unique peculiarities of the legal and regulatory framework within a jurisdiction to determine how that's best done. But also, too, in the case of Uganda, and I believe this will probably apply in other jurisdictions, there has got to be a way on how the deposit insurance scheme will be funded to be able to undertake this role. I've not had an opportunity of looking at the numbers of all the various deposit insurance schemes, but I think the target is, as long as you can be able to cover 90% of the eligible deposits, you're considered to be, reasonably doing well. But resolutions normally might demand much more significant sums. So now the question is, does the Treasury, should there be some kind of tripartite between the central bank, the Treasury, and the resolution agency to be able to handle that role? Those are the questions we are currently trying to grapple with in Uganda. But I do agree with you, it should be separated, and I believe the best home for that role is with the deposit insurance scheme.
Thank you very much, Doc, for that concurrence. Anybody else with some questions?
Thank you. My name is Fred Omach from Pride Microfinance. Thank you, Dr. Twine, for this very elaborate presentation. My question is about the macroeconomic stability, which may not be directly in the hands of the central bank, presumably in the hands of the Ministry of Finance of government. So to what extent in Uganda and maybe other countries are these contributing to failure of banks? The economic stability in the country, the role of the Financial Intelligence Authority, the over-liberalization, and then there is total excess banks in the economy, the issue of provisioning, the laws and regulations that really the banks find themselves completely getting out of this, and then the issue of where you have given out loans to your customers, and the customers have supplied government with the services, and government is not paying them, and then you're selling of their properties. To what extent is this contributing to these failures? Thank you, Chair.
Thank you, Dr. Twine. My name is Edna Kanavahita from Barclays /ABSA. My question is in relation to escrow accounts, which you mentioned in your opening remarks. These depositors, which may be indirectly or directly bank account holders, and extending it to agents within the banks, how are these indirect depositors protected? Are they collectively or individually insured?
Doc, you can answer those two questions.
Thank you. I'll start with the last question. The escrow account. The ongoing discussion has been, especially for Uganda's case, we largely have the escrow accounts holding mobile money deposits, so balances there in the wallets, which are significant sums with a multiple number of persons with a share. So for the deposit insurance scheme, and I believe we've had a couple of discussions with them, is should the insurance be per wallet or for the whole account? For the whole account, the current limit that we have, which we just raised to $3,000, would not apply, because the average balance on an escrow account is nowhere less than $30 million. That's the average balance. So how do you do it? Do you have a pass-through? If you have a pass-through, then who pays for it? Okay? That's the issue. And we're trying to look around and see what other countries are doing about it and how they're trying to handle it. But as a stopgap, as a temporary measure, the one approach would be that in the event a bank is going to be subject to resolution, it should be deemed that the assets in the escrow account should not be available for the resolution of that bank. That would be first stopgap while you figure out how to deal with those within, how to ensure the holders of the contributors to the escrow account. On the issue of macro stability, see, macro stability has got two aspects to it. There's fiscal and monetary. The fiscal policy, fiscal stability is purely under the Treasury or the Minister of Finance. The monetary falls under the central bank. Now, in the example you gave, when government runs up significant arrears to the private sector, which private sector has now borrowed from the financial system, yes, you might have what I would call it contagion, perhaps cross-pollination of bad manners. So the government runs up arrears, is unable to pay with the private sector has borrowed from the banking system, they're unable to pay back their loans. However, the banks, because they have lent out depositors' money, must be in a position to have buffers, capital buffers, and ensure that depositors at any one time are properly covered. The unintended consequence of that is that then you end up having the private sector not wanting to supply government, and government having to purchase its goods expensively, which then means government needs to raise more revenue, and it then raises taxes. So there's it's a circular issue, the chicken and egg, which came first. From a supervisory point of view, the concern remains that, like I said, one of the original objectives is the covered depositors and covered investors or creditors at any one time must always be covered. They must always be protected, because that's who our fiduciary responsibility first and foremost lies to. When an institution has been given the license or the permission to collect money or deposits from the public, the first person you want to ensure with that public is that whenever you do or want to, you must have access to your funds. So the lending to government or government running arrears with the private sector now becomes a business decision for the banks. And perhaps I believe this has something to do with when you look at the current, the new standard, the IFRS 9 that kicked in January last year, where now the financial institutions are now required, through the expected credit loss models and probabilities of default, to compute a provision at the time of originating an asset. So that at any one time, should the quality of that asset deteriorate, because those are funds or deposited funds, they are always protected. So once that is covered, then we now go further and say, okay, because once you have depositors lose confidence in the banking system or the financial system, you technically really don't have an economy remaining. So that's one of the reasons why we take that approach.
Escrow account protection.
Well, I think the escrow account, I spoke about it. So the Bank of Uganda has ongoing conversations with the deposit insurance scheme here on how best to, like I said earlier on, to protect the escrow accounts. But like I said, my opinion, it's not the Bank of Uganda opinion, my humble opinion is that as a first step, those assets or those holdings should not be part or available in the resolution of any bank that holds them. But then that requires that either mobile money or digital financial services provider the institution holding the account must have full visibility in terms into the platform on which the digital finance is run. That's one. Two, you must ensure that for every shilling, kwacha, pound, dollar that's in the escrow account is matched by electronic money. So there should always be a one-to-one relationship between the two. How then you protect the individual contributors to the escrow account is, one, you can have individualized deposit insurance, which, especially for Uganda's case where most of the money is from wallets and the balances on an individual basis are not that significant, because the average transaction in Uganda is about 24,000 shillings, which is under $7. So if that is the average balance on an account, well, what are you going to charge? And remember, this is a balance that moves on a daily basis. So how much are you going to charge as a premium? If someone is only spending 20,000, how much are you going to charge them as a premium? Because even the cost of collecting it or even trying to disperse those monies. Imagine a scenario where a bank has had a failure and you are choosing to, the Deposit Protection Fund has provided coverage. The average escrow account will probably have between 200,000 to 500,000 contributors. How do you even disperse those small monies to them? The cost of even reimbursing them can far exceed any purported benefits of having that scheme. So there's got to be a decision whether perhaps the one thing I can think of is to say that the funds in the escrow can be able to create interest or earn interest, but the portion of that interest must be forfeited to the deposit insurance scheme as a contribution for protection. That's one alternative. So there are a number of ideas up in the air, but we haven't yet settled on one, and because it's a discussion we, as the central bank, are having with the deposit insurance scheme here.
Next, it is my pleasure to introduce to you the woman of the hour when it comes to this conference, putting all this together, the CEO of the Deposit Protection Fund of Uganda, the woman who says she believes in being beyond excellent in her own words. A round of applause for Julia Oyet.
Thank you, Ishta. Mine is a very humble duty that I have to perform. Ishta has said I'm the woman of the week, but I want to say that I'm going to introduce the man of the week. And that is none other than Mr. Umaru Ibrahim, who is our African Regional Committee Chairperson. He's also the CEO of the Nigerian Deposit Insurance Corporation. And just before he comes, I want to assure him that he handed over the baton to Prince while he was away, and Prince stole all the limelight. Everything was about Prince on the first day. So, Chair, you handed over to the right person. So without wasting any more time, I would like to call upon you to address the gathering.
Thank you very much, Juliet. Juliet has been described as the lady of the week. She remains so until the program is over. I'm really delighted to be here this afternoon. I really missed the past few days, but I'm consoled by the fact that I'm well represented, as Juliet testified. She described Prince as, is it limelight? Well, I'm happy there is still a lot of light. I couldn't make it because on Monday we were summoned by our Vice President to attend an interagency meeting that comprised the law enforcement agents, the anti-graft agencies, ourselves, the central bank, the National Financial Intelligence Agency, and our Assets Management Corporation. I'm telling you this story because I'm not sure if there are countries that have established assets management corporations as part of resolution efforts, particularly as a result of the 2008-2009 financial crisis. But we did establish one in Nigeria, and it's about 9 years now. Unfortunately, not much progress has been recorded in terms of addressing the serious problems that plagued the banks at that time, which resulted in the acquisition of huge non-performing loans by the Assets Management Corporation with a view to restructuring them and recovering them through the courts. It has been a very challenging and frustrating experience due to a number of reasons. The issue of political will is very critical. And when Dr. Twins made this very elaborate and comprehensive presentation, one of the missing things probably has to do with, issues of political will. I'm not sure if, probably because he doesn't have any immunity, that's why he avoided addressing serious issues like the lack of political will and corruption in our systems. Because of corruption and because of problems of the judicial system, it has been very difficult to address some of these issues. The narration he gave in terms of the experience of Bank of Uganda in resolving these banks is a very interesting one, and I believe we in Nigeria and other parts of Africa have, in one way or the other, experienced all these issues. But I think one of the tough challenges has to do with political will and also the judiciary, the judicial system as a whole. So like I was saying, we had this meeting, we had to have this meeting because it is realized that there is need to renew efforts to ensure that those chronic debtors who have made it very difficult, even for the asset management company, are brought to book. And to that extent, an interagency, a very serious top-level interagency committee was established and is supposed to be reporting on a periodic basis to the Office of the Vice President. Without this kind of intervention, it is very difficult for you, even if you have the resolution powers, whether the resolution powers reside in the central bank or the deposit insurance or any other. And I'm saying this because of our political and economic climate in Africa. So there is need for us to appreciate that. For me, it's homecoming, more or less, to Uganda. The last time I was here was probably in 1994, when I had the privilege, and that was barely about 5 years when we established the NDIC, and I happened to be the head of what we then called Financial Institutions Resolution Department. We were dispatched after we read about the attempt to resolve the Cooperative Bank of Uganda. We read it in the FT at that time. We were fascinated, and at that time, we were trying to evolve our own resolution system, apart from the fact that we had to resort to multiple liquidation of some failed banks. We were fascinated, so we came to Uganda here to study the framework of resolving the Cooperative Bank of Uganda. Juliet later told me that it went into liquidation. We found that, just like the Dr. Twin mentioned, there were issues relating to governance, illiquidity, severe undercapitalization, and so on and so forth. And of course, huge non-performing loans. But what was interesting, if I'm still correct, is the fact that that bank enjoyed the support of NGOs some foreign NGOs injected some funds, but it got to a point whereby they said enough is enough. You know, we cannot inject any more funds. And there were huge hues and cries about corruption again by the NGOs, and this permeated most of East Africa. So that shows you that you cannot really own and manage a bank through donations. We learned a bit and we went back, and the memory still sticks. Having said that, I would like to congratulate Juliet and her most able team for hosting us. We will continue as Africa region to support our members to conduct more and more capacity building programs for our members. That is very critical, as much as we're also trying to promote the establishment of deposit insurance systems in Africa. We're also grateful to IADI under the most able leadership of Walker, David, as Secretary General. IADI has always been supportive of us. I think we are going to have a similar conference in November in Ghana. So one of the things we are going to discuss actually today at the ARC meeting is the need for us to form or establish a Pan-African Center for Research and Studies and Capacity Building for Africa. It doesn't have to be fixed in one place. The headquarters may be in one place, but we can rotate and come up with various programs that will help continuously sharpen the skills of our member institutions. I think with these few remarks, ladies and gentlemen, I would like to say we're grateful. I'm not supposed to be given the vote of thanks, somebody is, but in my capacity as Chair of Africa Region, I would like to urge all of us to continue to develop ourselves as individuals, because the tendency for us is that after these programs, in a lot of cases, we tend to put away what we've learned, more or less. I urge that we continue to develop ourselves and show interest. There is the IFS Connect, that is is a window created by IADI so that our employees can continuously update themselves on what is happening as far as deposit insurance practice globally is concerned, and I urge that we urge our staff to benefit from that opportunity. So I thank you very much.
Thank you very much, Chair. I'm now supposed to close this conference, but I want to say that it's not easy to close something as good as this conference. It should continue and continue, but they say all things come to an end, and I want to say that all good things come to a very quick end, and that is where we are, and that is how I'm standing before you now. So, fellow participants, I greet you all. Allow me to start by congratulating all of you for being very active, and I'm very sure that the information that you have got from this conference is going to help you to improve on your deposit insurance systems back at home, and it's also going to help those who haven't thought about it to actually think about it seriously. I thank the speakers, the moderators, who put in time to prepare and deliver to you in the most practical manner. The presentations were really lively, and I hardly saw anyone sleep. If anyone slept, maybe it was one or two, and I will not name, but I think we were all very alert, and I thank you for that. I wish to thank IADI, especially David Walker. He has been behind the scenes helping us organize for this. We started with monthly conference calls, and then it went into weekly conference calls, and we have Togarepi, who is our coordinator. Togarepi is from the Zimbabwe Deposit Protection Fund. He was always keeping in touch with us to make sure that everything goes as planned. I would like to thank ARC, my chairman, and the committee for allowing Uganda to host this conference for the very first time, for entrusting us with this responsibility. We're just babies, but we're doing work of adults, so we thank you very much. I'd also like to thank Bank of Uganda. Bank of Uganda has supported us from the beginning and continues to support us. We created a task force together, and the Bank of Uganda team was very active, never let us down, and we're continuing to work together. I thank Bank of Uganda. We have our committee heads, especially I must mention Hashim and Nakasi. I know many of you who came through the airport the other day must have met Hashim with his smiling face. Where is Hashim? Yeah, Hashim has really done a good job. I really need to single him out, and Nakasi. I think Nakasi, in the process of organizing, I think she even fell down, but she was still limping and telling us, go here and go here. So she didn't give up on her responsibility, and I thank her for that. I would like to thank Serena Hotel and all the service providers for doing their best to make sure that our guests received value for the time that they have spent with us. Of course, at the beginning, my chairman thanked our big brothers, Nigeria. You know, everything we learn from Nigeria. If we don't learn from Nigeria, then we go and learn from Kenya. If we don't learn from Kenya, then we go to Zimbabwe. So we have the hierarchy of our brothers. But there is one particular brother. Maybe this now is a father, because Tanzania was heavily involved before the DPF was created. We have had teams from the Bank of Uganda that went to Tanzania to benchmark. So when we came into the fund, we didn't know about the Tanzania support. But I want to say Tanzania has been the bedrock of the Deposit Protection Fund. And they say that we always leave the best for last. And I would like to say, Tanzania, thank you very much. Okay, this conference has explored various forms of deposit insurance agencies, and it described the different models that we can have. Basically, as a roundup, we have 4. You either have a pay box plus, a loss minimizer, or a risk minimizer. Of course, it's ideal for a deposit insurance entity to grow organically, and that has been stressed by my big brother, second big brother, Kenya, that it's best to grow organically, but we also know that it depends on the circumstances of the country, the structure, the supervision, and so on. So that is still left to each jurisdiction. The need for a deposit insurance entity to be independent has been emphasized. But that doesn't mean that a deposit insurance entity should be organized in any way. It must have sufficient controls, both at the top, through the organization up to the bottom. That has been emphasized during this conference. And the need for strong relationship amongst the various safety net players. And as such, governments, government agencies, and central banks must devise ways of working together in order to ensure financial sector stability. Our last presentation was about the success story of Uganda in resolving large financial institutions without compromising financial stability. And I think the figures spoke for themselves, and the governor, Bank of Uganda, and deputy governor always said, we resolved a big bank and no depositor lost a coin. And for that, we are grateful to the Bank of Uganda. Of course, the conference reveals some gaps that need to be filled. Already the chairman, ARC, has talked about the gaps that are there in the resolution aspect of it when we're looking at the judiciary and the need for that support. But in terms of the direct role of deposit insurance in paying depositors, of course, we're challenged because we have to try to work within the 7 days. The issue of claim form, I think now we're going back to rethink about it. If the claim form is going to make us delay, let us find ways of using other mechanisms other than that claim form. There is also need for us to involve in a lot of public awareness. And I was talking to my staff members and I was thinking that maybe we could even use like famous local musicians and ask them to compose a very nice song on deposit insurance, which is factual, and have that listened to, and the youth will always listen to that. People deep in the village know a lot of these musicians. So what we heard here is that we have to be very creative when we're looking at public awareness. So I urge each of you to go back and explore the different methodologies that you can actually adopt. And what has come out clearly is that we have to coordinate with the media when we're doing our public awareness, because you could be speaking to people and giving facts, but if the media is misinterpreting whatever you're giving out, then you're not really effective in your public awareness drive. The need for countries without DISs to start considering seriously the issue of setting up a DIS in peace times. I think the word that has come up clearly is that there's a difference between peace times and crisis times. So if you're in peace times, let us not relax. Let us find ways, sell these ideas to the different stakeholders, different supervisors, so that they can take on the message. Just before this presentation, we had a presentation on crisis management, and it's clear that we need to start a process of putting in place handbooks for crisis management. Of course, we've been alerted that this is a lengthy process because it involves different stakeholders, the different financial safety net players to come up with this. But it is something that we all have to start looking at. So members, with those not very few remarks, I would like to once again thank you for coming all the way from your different countries to be in Uganda to participate in this historic event, the first ever deposit insurance related conference to be held in Uganda. I'm sure you've been able to appreciate various aspects of Ugandan culture, the food, the people. I've been saying Ugandans are very warm, are very friendly. Anyone who disagrees, can you put your hand up? That is Uganda. And I look forward to hosting you to an excursion to Jinja tomorrow. I'm happy to note that all of us, the participants, especially from abroad, outside Uganda, are going to be participating, and I look forward to that. As you travel back, I wish you journey mercies and encourage the networking to continue. It is now my humble duty to officially declare the first IADI conference to be held in Uganda closed. I thank you very much for listening to me.
Ladies and gentlemen, Julia has closed the conference, so I'm just going to make a few housekeeping announcements. In case you haven't yet got a conference bag, please pick one up at the desk outside this door, and while you're there, just drop off the evaluation form. After the general meeting, the serious portion of the conference will be over, and our closing dinner dance is at 7:30 p.m. in the marquee next to the pool. Marquee is just a fancy word for tent, so follow the sound of the music to the white tent next to the pool. A tent is somewhere you sleep when you go to the bush, you go hiking. A marquee is somewhere you go to be wined and dined and dance. So at 7:30 p.m. next to the pool, follow the sound of the music. Thank you.